Hi everyone, welcome back to my channel. Today we are going to study about liquidity ratios under ratio analysis. So first we need to understand what are the liquidity ratios and why is it important. Now the most important liquidity ratio is the current ratio. The formula for current ratio is current assets divided by current liabilities. The ideal ratio is 2:1. This means that for every $1 bill of current liabilities, the company has a leverage or the company has current assets worth of $2, which means that the company has 2:1 ratio. That is, the company is well covered to meet its short-term liabilities, which is the current liabilities. Very important to understand here is what is net working capital. The formula for net working capital is current assets minus current liabilities. This is the net working capital. So, in order to understand the liquidity or how soon the business can repay its current liabilities after realizing its current assets, is the overall liquidity position of the company, which shows how liquid the company is in repaying its short term liabilities or short term working capital or funding requirements. Then comes the quick ratio, or which is also called the acid test ratio or the liquid ratio. Now here the formula changes from the first formula of current ratio. It becomes current assets minus inventories minus prepaid expenses total divided by current liabilities. And the ideal ratio for this is 1:1. Now, why we minus inventories and prepaid expenses is because these two items are not easily convertible into cash. These are not easily realizable into cash. That's why we deduct these two items from the total current assets to give us the quick ratio or the acid test ratio. This is like the acid test or the litmus test that we do to know how liquid the company is and how soon the absolute liquidity requirement of the company can be fulfilled. Hence, the ideal ratio for this should be 1:1, which is in absolute terms. Then we have the cash ratio. This is another extension of the quick ratio, but here we do not take everything else. We basically take the cash component, which is cash plus bank, and marketable securities, which is the marketable content of the securities. That means it is easily realizable or convertible into cash. So cash plus marketable securities divided by current liabilities gives us the cash ratio of the company, which shows how cash rich the company is. So these are the three main liquidity ratios for any company, for any balance sheet analysis, for any financial analysis to be done. These are the main three ratios to look out for, which in turn tells us the working capital position of any business. Please subscribe to my channel and thank you for watching.